Hi everybody, this is Also Hub. I'm Giacomo, and today I'm going to analyze John Deere. This is one of the stocks that you asked me to analyze. So before we get into the video, make sure to like, subscribe, and comment. This is not financial advice, so make sure to do your own research before investing. And the data that I've taken comes from Seeking Alpha and the New York University website for the risk premium and so on. If you want, you can get a discount on the Seeking Alpha service by going into the link in the description below. So let's get into the analysis of today. First off, we make the assumptions for the cost of equity and the cost of debt. We start off with the cost of equity. I've taken the interest rate swap for the next 10 years that, as of now, is floating around more or less 4%. Then we have the risk premium, and in this case, I've taken again the risk premium indicated by Aswath Damodaran for this year, that is 4.6% for the United States. Then I've taken the beta, I've taken the last 24 months beta, and I've taken that into account to come up with the calculation of the cost of equity. So here's the formula if you want to do it yourself. Then I take the cost of debt. I've put some height spread because John Deere has been a little bit volatile with with the revenue, the growth in free cash flows and so on, and it's more, let's say, cyclical than other businesses, and it has, on top of everything else, a high debt to capital ratio, which is good if you want to lower the cost of capital, but it could be a burden if John Deere were to incur into some bad times and not do so good. So I've taken that into account. So here's the assumptions for the weighted average cost of capital for John Deere, and here's some of the highlights of what it has done in the last 10 years from a perspective of revenue growth, earnings growth, and free cash flow growth. So here's the situation. We can see that the growth in revenue is quite stable, even though it has done pretty good given that it's not a new market, the agricultural machines that John Deere makes. It has delivered pretty well, and it has improved its technology probably from now on. The workers that use John Deere's machinery will need John Deere not only to sell the machinery but also to repair and so on, because now these machines rely more and more on software, and you need the John Deere itself to put hands on the software that it has developed for these machines. So probably John Deere will probably improve the revenue also on that side. So that's really, really interesting. The earnings, it has done really, really good. It has basically tripled the earnings in 10 years. So really good stuff. And then we have the free cash flow that it has done really, really well, even though we can see that for some years it has gone negative, and it has been pretty volatile. So we have to take into account that in order to make some good assumptions on John Deere. So here we start by making assumptions. Given that as the trailing 12 months data, we can see that for this year it's having a little bit of a harder time compared to last year. So I've taken the growth until the end of the year pretty low in order to stay conservative, and then I've made it a little bit higher, going closer to the one that it has delivered in the last 10 years. So I've taken that into account. a 20% growth year over year for the short term, and then for the medium term, more or less around 10%. Because yes, it is a great company, great machinery, great technology, and so on. But the agricultural sector, yes, it will probably grow in some geographies. If you think, I don't know, South America or Africa and so on. But in many countries, it is quite stable or either stagnant. So it's not a super high growth market. But probably John Deere will be to serve people in this sector with new machinery and with great machinery, with great technology. So I've taken that some of that, let's say exceptionality of John Deere into account for these figures. But yeah, I prefer to stay conservative, better be safe than sorry. So yeah, these are the explanations for these assumptions over here. Then I've taken the long-term growth of around 3%. So that is the, let's say, expected growth for the US. Probably this company will develop more abroad. But yeah, I've sticked more or less to that 3% that I feel comfortable with. So yeah, then we take into consideration the terminal value. Here it is. Here you have the calculation, and then here's the present value of that figure, and we take the sum of the present value of the free cash flows, and then we add the terminal value, the present value of that terminal value. Then we subtract some of the things that could dilute our position. For example, the net debt position. Here we have almost $63 billion in debt, and we subtract the value of the options. Here it is. Given the weighted average exercise price as of the last 10K. I haven't done the Black-Scholes model. Probably if we take the fair value, given the Black-Scholes model, it would be higher than this. But you have to take into consideration that given that the share price is higher than the exercise price, they will be probably exercised sooner rather than later. Actually, given the last drop, it is around 316, and we can see how that changes. Here's the exercise price, the value that I've come up with for the options, and then we have the restricted and performance stock units. Here's the value that I've taken given the current share price, and here's the value of the estimated value of the equity. Then I divide it by the outstanding shares, and I come up with this figure that is around 40% higher compared to the current share price, which is pretty good. It would make it a buy. I'm conservative, so I would have a, let's say, margin of safety of around 15-20%. But given these assumptions, I've been relatively conservative. I think that John Deere would be a pretty good value. We could make it even less than that. We can see how that changes if it were not to deliver as good as I hope. Even with these lower assumptions, it would still make the value a little bit higher compared to the current share price. So interesting. We have to see how things develop. I think it's very likely that, given what has happened in the last week, probably the Fed will will cut rates. So it would be pretty good for John Deere, given that it has a pretty high debt to capital ratio. But we have to take into consideration that there is risk, and maybe we'll have a few not so easy quarters. So maybe we'll see some more volatility before things stabilize. So yeah, better be safe than sorry, as I said. So I think that, given what I've said, John Deere is a really good company, really good technology, and so on. So I think it would be a pretty good buy, given that, yeah, I've already stayed conservative compared to what it has done in the last 10 years. So let me know what you think in the comments. So make sure to like, subscribe, and comment for the next videos, and let me know which stocks you want me to analyze. So this is it for today. I'm Giacomo. This is Also Hub. See you next time.